If you're waiting for a clear signal on the chart before taking action, there's a good chance you're already months behind this cycle. Right now, most investors are doing the same thing. They're staring at the Bitcoin price, waiting for confirmation. But the most important signals of a cycle almost never appear clearly on a price chart. And ironically, by the time they do, it's usually too late. If you're watching this video, there's a high probability you're in one of three psychological states. First, you're holding Bitcoin or altcoins. Your portfolio is down maybe significantly, and you're waiting for a rebound to fix the damage. But the more you watch the market, the less certain you feel. Should you hold average down or do nothing at all? Second, you're out of the market. In cash, you avoided losses, but now you're frozen. One question keeps looping in your head. Is this finally the end of the drawdown, or am I still early? And third, you're relatively calm, rational, not panicking, but something feels off. Bitcoin isn't crashing, but it isn't breaking out either. Price is flat. Volatility is compressed. News flow is quiet. And this silence is exactly what traps most investors. Capital is idle. Portfolios are bleeding. Some down 50%, some 70%, some more. Yet there's no clear signal telling you whether to stay, exit, or act. If you're in any of these states, let me say this directly, the periods where investors make the worst mistakes are not moments of extreme panic. They are moments when it feels like nothing is happening because the market is never idle. The real pressures of a cycle don't always show up as red or green candles. If all you do is watch price, it's easy to shrug and say, there's nothing here. But if nothing is happening, why is the group that understands Bitcoin's system the best under the most pressure right now? I'm not talking about retail investors. I'm not talking about long-term institutions. I'm talking about the backbone of the Bitcoin network. The miners are not investors like you. They don't have the luxury of waiting 3 more months to see what happens. They have real costs, electricity bills, debt payments, hard deadlines. When miners sell Bitcoin, it's not because they think price has topped or valuation looks attractive. They sell because if they don't, they shut down. They are the only participants in Bitcoin who cannot wait. Historically, this pattern has repeated itself again and again, and it always appears when the market is quiet, boring, and demoralizing. At that point, selling is no longer strategic. It's forced, and that's why across past cycles, minor forced selling tends to emerge near the peak of systemic pressure. It shows up when retail loses patience, when conviction fades, when people stop paying attention. This is what we call Bitcoin miner capitulation. It's not a short-term price signal. It's a system level signal. It tells you where the real stress of the cycle lives and where you are standing within it. If you understand this, you don't need to guess the bottom. You don't need to predict tomorrow's move. You only need to answer one question. Is this a phase where you need patience, or a phase where the patience of the largest, most constrained players is running out? To answer that, we need to look at minor capitulation seriously and structurally, because this time it isn't resolving as quickly as it did in prior cycles. And if you're still waiting for a clear signal to act, that hesitation itself may be the real risk. That's exactly what we're going to break down in the next part of today's video. Many people think minor capitulation simply means miners turning off their machines. The reality is much deeper. In every Bitcoin cycle, miners are the first group to feel pressure when the market regime shifts. Why? Because they are the only participants with fixed cost in fiat and revenue in Bitcoin. Look at the macro environment in late 2025. This is not 2020 or 2021. Back then, we had zero rates. Quantitative easing, unconditional cheap capital. If you plugged in an ASIC, you printed money. Today, cost of capital is higher, financial discipline is back, and a thin margin business like mining cannot escape that reality. Here's the key point. Minor capitulation is not random. It's the network self-correcting mechanism. When three forces converge, price declines or goes sideways for too long, block rewards compress halving, low fees, energy costs, debt, and depreciation remain rigid. The system must eliminate its weakest participants. This is economic natural selection. Inefficient miners, over-levered miners, they get wiped out so more efficient operators can survive. So why do I pay so much attention to this signal? Look at history. In 2018, Bitcoin fell from $6,000 to $3,000. Miners capitulated, hash rate collapsed. That marked the cycle bottom. In 2022, after FTX imploded, miners were forced to sell again. Once more, a long-term bottom. The common thread wasn't price. It was forced supply leaving the market. Miners are the most consistent natural sellers of Bitcoin. In normal conditions, they sell daily to cover operating costs. That selling pressure is always there. But during capitulation, those who are forced to sell everything quickly to survive or to shut down. Once that process ends, once weak miners are flushed out, forced selling disappears. Supply dries up, and at that point, even modest demand can push price higher. That's why minor capitulation has historically been one of the most reliable signals that a long-term bottom is forming. It marks a transfer from those who need liquidity to those who have it. So what's happening right now? We have to look at on-chain flow and capital movement. There's a major misconception I want to correct. Miners are not panic selling. They're selling because they have no choice. On-chain data doesn't show sharp panic spikes, no sudden 50% daily crashes. Instead, we see something more dangerous, a steady, persistent flow of Bitcoin. From miner wallets to exchanges, this is slow bleeding. Efficient miners aren't selling. They're accumulating, but weaker miners, especially those with debt, are being forced to sell into the worst possible conditions. And this is what most people are missing. This cycle is different. Minor capitulation in 2025 is no longer just about electricity costs or machine efficiency. It's about leverage. In 2018, miners died because of energy prices. In 2025, miners are dying because of debt. Many mining firms have become financial entities. They borrowed to expand. They collateralized Bitcoin. They tied themselves to traditional capital markets. When mining profitability falls, the issue isn't, is mining profitable? It's loan covenants, margin calls, interest payments. Capitulation doesn't happen in a single day. It unfolds through reluctant decisions, week after week. That's why price action feels heavy, boring, unresponsive. Retail asks, why isn't price going up on good news? The answer is forced selling pressure from miners. Look at social media today. You'll hear institutions are here. Infrastructure is better than ever. Adoption is growing. The narrative isn't negative. And that's exactly why complacency is dangerous. Historically, the most painful phases of a cycle are not marked by disasters. No major collapses, no dramatic crashes. Just price failing to respond. Minor capitulation lives in a zone I call not bad enough to scare you, not good enough to reward you. Technically, and I always treat technicals last, we're seeing hash rate flatten or decline. Hash ribbons are transitioning, but let's be clear. This is not a buy signal. Hash ribbons don't tell you when price will rise. They confirm that systemic stress exists. Think of it like a vital sign. It doesn't tell you when recovery happens, only how severe the condition is. So what does all of this mean for you? First, risk. The biggest risk right now is not Bitcoin going to zero. It's having the wrong expectations about the speed of recovery. Many investors expect a V-shaped rebound. Once capitulation becomes visible, history suggests otherwise. After capitulation, markets usually need time, reaccumulation, absorption of excess supply. If you're using leverage during this phase, expecting immediate upside, sideways volatility will punish you. Second, opportunity. Behind the surface noise, a forced cleansing is happening. Bitcoin is moving from weak, leveraged hands to disciplined capital. This phase doesn't reward short-term traders. It rewards those who understand that when someone is forced out, the real question is, who can stay and why? The miners who survive this purge will control more hash power once difficulty adjusts. And when demand returns, they will benefit disproportionately. The same logic applies to investors. If you can endure the boredom, the discomfort without being shaken out, your positioning for the next phase becomes extremely strong. To summarize, minor capitulation is never comfortable. It's painful. But in every cycle I've witnessed, it's been a necessary transition before the system rebuilds on stronger ground. Don't try to call the exact bottom. Manage risk. Understand that this selling pressure is structural, not emotional, and be patient. Thank you for watching. If you value data-driven analysis over empty promises, consider liking and subscribing. I'm Ben Morgan. I'll see you on the other side of the chart.